Today, we will concentrate on three broad sectors linked to India's exports, specifically India's trade deal with the US and the export promotion mission. The first is gems and jewelry, and while a Titan or a Kalyan Jewelers could also make for interesting bets, I'm going with a company known for being a little suspicious. It is called Rajesh Exports. It's a stock that has corrected by about 80% from the top and shows very few signs of a rebound so far. Naturally, analysts are extremely bearish on the company, but there are two reasons to be bullish. First is the fact that it processes 35% of the gold produced in the world. With trade deals around the world coming together, Rajesh Exports should find exposure soon. 98% of this company's revenues come from a subsidiary in Singapore, a hint at how internationally inclined the company is. It is also the only government-recognized 5-star export house in the jewelry sector. The second reason is the change in promoter ownership. Mr. Rajesh Mehta, the primary promoter, just took over another 12% of the company from other promoters. So while a screener for promoter buying might not highlight the stock internally, something big seems to be brewing. However, it is a high-risk play, so I'll be taking a small position in the company, most probably through an SIP. The second company is from Food Exports, specializing in shrimps. 99% of Apex Frozen Foods revenue comes from exports, with more than 60% coming solely from the US. Suffice to say, the stock suffered greatly from the tensions between India and the US. Consistent FII interest, and that too by an institution such as MIT, shows the potential for re-rating though. The company is trading at 1x sales, which is unusually low. LT Foods, for example, trades at 1.5x sales even after a 20% correction. There is definitely some room to capitalize here. And next up, we have textile stocks, Indocount being the first one, which is the largest global bed linen player. 75% of their revenue comes from the US. The stock has shown signs of life since trade negotiations have begun, but until the massive tariffs on Indian exporters is reduced, their demand will continue to diminish. It is very important to remember that this fall in exports has not showed up in quarterly results yet, since most exporters had front-loaded their supply in anticipation of tariffs. If the tariffs continue for another quarter, these companies will see corrections, but if the tariffs are removed, they will see massive gains. And next up, we have Kitex, which has 69% of its revenue coming from the US. It is the world's second largest producer of cotton and organic cotton ready-to-wear garments for infants and children, especially in the affordable segments. The higher tariffs on Indian goods has a disproportionately high impact on affordable products, which can explain why Kitex corrected by almost 50% this year. A removal of tariffs will naturally have an equally strong positive impact on the stock's price. Himmat Singh see this next, and 85% of this company's revenue comes from North America. The company supplies to major global brands like Calvin Klein, Tommy Hilfiger and Kate Spade, all of which dominate in the US. The company's quarterly results showed clear signs of a slowdown, but they were hidden by a one-time other income of about 70 crores. While smart accounting practices can help the company survive a quarter or two, the removal of US tariffs will be the real trigger for a re-rating. The stock is trading near a 2-year support and well below all-time highs. For long-term investors, this could mean a very nice time to start accumulating the stock. Gokaldas Exports is next, and 3/4 of their revenue comes from exports, so the global trade war has hit them hard. However, the company is both brilliantly diversified and heavily reliant on established relationships. Nearly half of their revenue comes from business relationships that were established decades ago, meaning they will bounce back stronger than most once trade tensions normalize.